Hi.
Hi, Taka. Hi.
Hi, Sylvia.
How is New York?
It's nice. Weather's finally warming up. It's pretty nice out, sunny and 60 degrees Fahrenheit. So that's nice.
So you're going into summer now.
Just early spring, but yeah, it's warming up.
Okay. And how are you?
I'm good, thanks. Had a nice weekend. How are you doing?
Good, good. Um, it's Sunday night for me, so it's nice to have you, to have you on this podcast.
Well, thanks
And
for asking me.
yeah, I'm very delighted that you found the time to do this.
No worries. Glad to help out. And
Okay, so let me start by introducing you to the audience because I don't think some of the people know you and your background. So Matthew Tucker, CMT, is a technical analyst covering foreign exchange, fixed income, emerging markets, equity, and commodity markets. Matthew has over 18 years of global macro market analysis and trading experience. And prior to joining Informa Global Markets in 2016, he designed quantitative trading systems for commodity and equity instruments at Kershner Trading Group and T3 Trading. He has several years experience as a global institutional equities program trader and market analyst with Neonet Securities and Pensera Securities. In addition, he's also my fellow at World Quant University pursuing a master's in financial engineering. That's a lot, Taka. So I don't know, maybe you can tell us what you do in a nutshell, because you really, your experience is quite a lot.
Thanks. Well, I've been around for a little while now, so it just starts to accumulate, I guess. It's just the nature of things. So currently, my role is a market strategist / technical analyst for a market research firm, Informa Global Markets. And we cover, I'm one of the analysts. We have analysts worldwide. We have an office in Singapore and also London. So we have 24-hour markets coverage, and we cover basically global macro instruments, mostly FX and fixed income, but we also do equity indices and commodities, and we do technical analysis on charts. It's great. We get to basically draw on charts all day and try to predict the movements of financial instruments. And I also do some other work, not just it's technical analysis related, but I do some back testing, systems testing, and testing the profitability and success rate of certain indicators and stuff like that. And that's also something we do. I do some simulations using Python. So that's generally what I do. No trading with this job, but I've done it was all trading before I got to this job. I did start off as just a prop trader doing manual trading, or then did that for a few years. And then I transitioned into automated trading. Did that for a little, then I did institutional trading international markets, and then that's led up until, and then I did some more systematic trading at, like you mentioned, Kershner and T3, and then that was led up until where I'm at Informa now.
Okay, so given what you do, our focus and our topic today will be technical analysis. So that's what we will be discussing. So you've been doing this for 18 years now, close to 2 decades. Like, what triggered your passion into trading, and what keeps you, going and grounded in this, financial markets?
That's a good question. I think I've always just kind of had an interest. I think it's a common human characteristic to be interested in forecasting and speculation. You see how people like to gamble. I think that I'm not likening trading or technical analysis to gambling, but there's just a common human instinct to try to predict the future, because we live such complex lives, and to me, it's just something that I've always been interested in, because that's really what it boils down to, trying to forecast where things are going to the best of your ability. That's the simple answer. What keeps me grounded and growing, I guess, is just, I've been doing this for so long, and I've had ups and downs in my career, and I feel like I was forced to improve myself, because you have to be, if you want, the landscape in any career, in any industry, is going to be constantly changing, and it's going to be increasingly so, as we evolve in society. And I feel like you need to just constantly be generating new skill sets and trying to just increase your how well you can perform within your industry. The main thing I've done with that is I taught myself coding, and there's just so much you can do online now. There's so many free resources, and even you can pay a little bit, but you can just, with YouTube and with other of these coding academy type websites, and just buying some books. There's really no excuse. You can teach yourself anything. It's just putting the time and effort in.
Yeah, and I have to agree that in today's world that, being ignorant is a choice given the resources and the tools that we have. You mentioned that you were initially in a prop firm doing manual trading. How has that transition to, automated trading and what you're doing with your systems testing and simulations, how has that, affected your profitability in the long run?
It has a lot. I mean, the thing that I consider systematic automated trading they're pretty much the same thing. It's just it's automatic discipline is the way I see it. And if you do enough prop trading, when you go through different market cycles, you just being honest, like you develop bad habits, or bad habits materialize, throughout the course of, the short-term trading cycle. It's just, your demons will come up. These are just, common characteristics of human psychology, and it's impossible to avoid them. And, the best traders can minimize those, but over time, like and especially when you go through different things where, everyone finds a niche where they're successful, but the market dynamics change. And so you start to reach a point where I was a manual trader, and you take notes, and, I see younger traders doing that at the last prop trading firm I was at, and I kind of smiled. And because you start to write yourself notes, like, do this when this happens. And then, and I'm speaking for myself. I was always attracted to the idea of automating. Initially, it was because of, to try to scale what I was doing. I said, what I used to do when I first started trading, it was kind of like I was a de facto market maker. I was part of the SOS bandits, as they called it, the small order execution system, when private traders had direct access to the electronic markets for the first time. And, I was good at that. And what I would do is I would trade one stock, and I could just watch the order flow. And anytime the stock moved in any direction, up or down, I was on it, and I could make money. I would just always pay the spread and then hit the bids on the way out, or vice versa for shorts. And it worked. And I wanted to scale that out, to try to do something that would do that automatically in a bunch of different stocks. And it worked for a little bit, but the markets changed so fast. People realized that how we were making money, and we basically had eliminated market making in its old form. These banks used to sit around and just quote and make the spread, and charge the clients the spread, basically. And that was eliminated through the activity of these traders in the late 90s, early 2000s. Going off a little bit of a tangent here, but really it's discipline. Like, to me, that I see automated trading basically as just pure discipline trading, because the ideas are still, you come up with a theory and you're just testing it. You want to see how well it does, and you're just going to execute it over time. The challenge with automated trading that you'll run into, though, is that it's cyclical in terms of the profitability of any model. And so nothing's going to work forever is basically the challenge. And the question is knowing when to stop trading a model.
Yeah. Okay. When you designed the quantitative trading system for Kershner Trading Group and T3 Trading,
Mhm.
was that at the same period when you were doing the testing and trying to do the coding?
Yeah, definitely. Yeah, because that was the basis of those systems, was back testing and trying to avoid the pitfalls of um, curve fitting, etc. Um, but yeah, um, for T3, I was trading metals futures, and it was an interesting system that I have this indicator that we use, a short-term indicator at work, that's basically the same idea. Um, it's kind of a medium-term price change, a couple trades a day, um, and yeah, basically testing how well things work, and then going under the assumption that for the immediate practical future that the markets will behave the same, but obviously those things can change anytime, so you have to be aware of that.
Okay. And the beauty with technical analysis is that once you get the skill, then you're able to trade any derivative. So like you can trade currencies, you can trade commodities, you can trade even the digital currencies, the likes of Bitcoin and etc.
Yeah.
So for you, because you've been trading equities, Forex, commodities, and emerging markets, do you have like a favorite among these derivatives?
You mean for my personal trading?
Yeah.
Not particularly. Equities are ubiquitous, but I tend to just trade mostly on. I like to trade ETFs, broad market. I think that stems from like the period that I was trading equities heavily. I just don't. You would come in, and we were intraday traders, but occasionally people would have positions overnight, and I just have this in the back of my mind. Some of these, I just never really trust what companies are doing. Because I would see. People would come out and there'd be scandals and stuff. And I just prefer to trade sector ETFs and stuff like that. But yeah, that's the great thing about technical analysis, like you were saying, is that a chart is a chart. The only thing you have to keep in mind that the trading perspective gives you is the underlying liquidity. You can look at a chart, but if there's really not much liquidity, then it's not feasible that you'll be able to trade at the extreme levels of that chart. It's hard to really grasp that from just looking at the volume, because it's all relative to that chart only.
Okay.
Yeah, some charting packages will show you the spread, but I don't know if they track that, through time. But still, that's just something to keep in mind. But yeah, equities, and I like foreign exchange too. Just liquid markets.
It's actually the most liquid, market to trade in.
Yeah,
Yeah.
yeah, that's right.
Okay, so like you're saying, you study a chart, and that gives you, you're able to predict where, based on the liquidity, what move you should take. So technical analysis being about price and trends and the study of, using charts to make your predictions. Can you tell us about the use of Japanese candlesticks, for example, in your speculation and in your analysis?
Okay. I haven't, there were some, I did at one point look a little bit at testing some chart patterns, candlestick patterns, but I didn't really see much success with that or much predictive power. That said, in the day-to-day kind of just manual analysis that we do, I tend to definitely incorporate it to a high degree. And what I do mostly, I would say, is wick size, and the real candle body is this, what really stands out to me. And that really gives you a judge of momentum, and it's a really quick way. If you can, and it's all within the context of what's happening on the chart. So if you start to see, if there is a downtrend and then you start to see longer lower shadows, which I don't know if your listeners, understand what that means, but that's where a longer lower shadow suggests that a significant portion of the range was below either the open close, wouldn't be the high because it's to the low. That just suggests that even though prices were selling off, that there was a rebound intraday. And so when you start to see, and it's not just one day on its own, but it's when you start these things start to cluster, it can be significant. But it's everything with technical analysis, and I'm sure people have heard this, but it's completely true, is that you have to combine different indicators and methods to really start to get a good picture, because anything on their own, the edge of that is really small. Like,
Yes.
yeah, you're talking like 52%, 53% edge, so 3% edge. So you really want to be combining that with other, other methods, or other indicators. But it's common. I mean, that's with the charts everyone uses at the firm is candles, and candles are they're useful. And also just the size of the body. Speak a little bit about that, which is the non-wick portion of the candle.
Yes.
Can show you. It's a good quick way to read how much momentum there was. So if there is a large body and then there's small wicks, that shows you that to me is a directional move, or suggests that. One thing that was really interesting to me when I was at Kershner that I discovered, at least in the U.S. equity markets, that really was surprising, but it was something that stood out, and time again I would see it in terms of the back testing, was that on daily charts, when you look at the range, and this has nothing to do with candles per se, but we look at the range of the day's bar, that actually let's say that a stock was an up day. And then what I did was, you can divide the range of the bar into whatever percentage you want. And you could just say, you could divide it into quartiles or whatever. But what I would do is I would test different settings in it. And the higher that the stock finished within the range for the day, it was actually more bearish. And I would test to see, one of the filters I looked at was, did the stock finish in the top 5% of the day's range? And if it did, it actually was more likely to finish lower the following day. And we're talking, I forget exactly what it was, but it was like 56, 57% of the time, which is significant. That was, that really stood out. That gives you an idea of the type of edge that you'll see in some of these setups or indicators. And my interpretation of that is, it's kind of a capitulation. And what that says is that if there was so much buying interest and that the market finished towards the top end of that range, why did the market finish down the next day? Because the buyers were exhausted. And it also is the same, to the downside. So I find that really interesting, and because there's also this view, and it shows you why it's important to back test too, because people accept it like gospel that in technical analysis, they'll say, it's bullish if we finish at the high, but that's not, it's actually the opposite. So that's what's great to me, is like, it's about incorporating programming into your workflow, because you can test and see how well it works, and if it's true, and knowledge is power,
Yep. So like, from what I'm hearing is that, and you can correct me if I'm wrong, like, you sound like an intraday trader. Is it?
Yeah.
Yeah.
Well, for me now, when I trade on my personal account, it's not like I'll trade swing trading style, and more just basically holding things for months at a time. But I mean, I can do both. In terms of what I'm looking to do, in terms of system and modeling, it's a little more short term than that. But I also have stuff that I'm working on where it's more like rebalancing on a monthly basis, or pairs trading where you're holding for a few weeks. But I like to work within all those time horizons. So.
Okay, so what I was meant to ask you, because price action and technical analysis, it's about having your own process and a strategy that you use when you're getting in and out of the markets. So how did you come to identify your trading style, with this kind of trading?
With the automated trading?
Yeah.
Or just, so to me, it was beneficial that I was doing especially when I was on the sell side trading, and I would publish notes every day to send to clients, and just being in it and trading and looking at and knowing, and also studying for the CMT, because you basically get introduced to all possible types of indicators. And so I knew I had a firm grasp of what was available. And I kind of found a couple indicators that really stood out to me that were dynamic and that really described price action really well. And those are Bollinger Bands and regression lines, linear regression lines. And all of the systems I built were based off of those indicators, and I still actually use those both those indicators in models that I work on to this day. Yeah, I mean,
is that you do you use those indicators to determine your entries and your exits, and also what's your risk management model like?
Risk management, well, what I found works best is volatility based. So you're basically, you have to ask yourself what you're doing. When you want to get out of a trade, you can't use fixed. I mean, you can, but you're going to improve your returns when you use a dynamic exits. For me, the type of trading I do, manual and automated, is basically, it really boils down to identifying a broad trend and then finding when the trend of a smaller degree is moving against that. So it's mean reversion essentially, but it's still following the broader trend. So that's the edge. So I'm exiting. That's also, my exits are dynamic. I'm usually exiting at the forecasted regression price for that time period, or at the moving average, which is usually like a 20 bar average. In terms of exits, you have to say when there's adverse volatility, it's relative. The volatility can tell you basically what the typical move is over the last X bars. And so when the volatility exceeds the average, that suggests that there is something new moving into the market and you need to get out. So usually it's a multiple of the ATR, which is very useful.
Okay.
Average true range.
And how long do you hold on to your positions? And what would you like? Do you have a place for patience in your trading?
A place for patience?
Yeah.
See, I don't consider that when I'm trading. Most of the time, it's I have an idea of like it's model based, so there's just, and that goes back to like what moved me towards automated trading in the first place was not having a firm idea when you get into a trade where you're going to exit is a really difficult and dangerous position to put yourself in, because you will try to talk yourself out. That's the toughest thing too, and that's the mind will always say you're down and you're close to your stop, and you'll say, you'll start to think. You might start to tell yourself, I'm sure as soon as I hit this bid, like it's gonna, because you'll do that. You trade over, and you'll have times where you sell, you get stopped out, and then the market reverses right there, and you'll think that, and you'll say, okay, I'll just give it a little more, and then you'll get. That's how people blow up, accounts in days. Is that kind of martingale type of approach. So when I hear a term like patience, listen, I guess I could circle back around and say patience is definitely key, because you don't want to overtrade. That's a separate issue. But in terms of how I originally interpreted your question, I would just say no, that to me sounds like an emotional type of thing. But patience is definitely key, especially if you're manually trading. You need to be able to pick your spots. And one thing you should always consider, I read in some book, but I totally agree with it, is that it's better to miss a trade and survive until the next one than it is to trade at the wrong time and lose your capital, in which would take you out of the game eventually. So that's where patience is definitely key in that regard.
Okay. Now, you were once trading manually, and most of our audience locally usually are on manual trading. So would you give us an example of one memorable trade where it was one of your biggest, either, good or bad, but you still remember that to date. You can give us one on manual and, one in automated, and what you learned from your experience.
Okay. Yeah. Oof. Well, it's funny. Maybe it's human nature, but what stands out is a big loss because we're hardwired to remember painful stuff more than the good stuff for, I guess, evolutionary purposes. But yeah, it happened twice, I guess, where I had a huge loss. And it was, I think, I was trading this, again, trading a single stock, and it was on a slower day, and I just accumulated a big short in this stock, and it wasn't moving. And, there's someone on the bid that kept buying, and I just figured eventually they would stop, but it popped on me just like a buck or two and took a huge loss, which is very painful. And so what I learned from that was to not try to force the market, and to not, a couple things that, and also to try to not, on days where there's little happening, I should have had more patience. See, it circled around to your previous question. It also tends, I think back to that too, and it reminds me, kind of brings up these issues of psychology, and you would get into these things. I know that, like, it's kind of like human nature. It's kind of like with speed. If you're going 60 miles an hour in your car, and then it's relative. So if you have to slow down for something, and then you don't feel as if you're doing as much, or you don't feel as good about your speed until you get back up to where you were before, because it's all relative. That's what you're used to. And I know that there was a point when I was manually trading where it was that with position size, and if I had a certain size in a stock, and then I was trading in and out of it, and then I opened up a smaller position, it just didn't feel right. I wanted to be getting as much action, and that's just kind of there's certain psychological factors, I'm not a psychologist or anything, but there's definitely something in human nature that forces you to try to maintain a certain level of exposure to just the markets and to whatever else it is that is creating some sort of stimulus in your environment. In terms of the trade that stands out for the automated stuff, it's not necessarily one trade, but when I was trading that system on the gold futures and silver futures, there was a couple runs where I had over 20 straight trades profitable, like 22, and then there was another one a month or two later where it traded like 24 consecutive winning trades. That to me I'm really proud of that, that's just the way it is. Like, that just shows you, and that's something that model blew up like 2 months later, and it wasn't profitable for 18 months. So it just shows you how things can work great, where you have something that has that many trades, you feel like, even though I don't believe that there's such thing as a holy grail, but it sure feels like that at the time. But
Yeah.
Obviously nothing like that exists, as I was taught later, a couple months later.
Do you keep a trading journal? Because if you do, then maybe recording what made you make profitable trades, and then you would repeat the same thing, maybe that would help. Do you keep a trading journal?
I don't, just because I don't trade that actively manually, but I think that's a good thing for people to do, because the more that you can, a journal, what that implies is that you're sitting down sometime outside of trading, and your emotions have calmed down, and so you can think more rationally about it. Because let's face it, when you're trading, you have to deal with the human body and the emotions that come up with that. And so, like I was talking about before, you're going to have these instances where you're second guessing yourself, and you're going to think this time it's different. So whatever you can do to reinforce the lessons you've learned, that's definitely helpful, I would think, for manual traders. Absolutely.
Okay, and as a CMT, Taka, you have covered lots of books, because I know a colleague of mine who's also pursuing CMT. He's just finished level 2. What book would you recommend on technical analysis?
Okay. Well, I believe now, just as an aside, that they have when you study the CMT, they have textbooks that basically have excerpts from a bunch of different books. But when I was taking it a few years ago, you had to buy the individual books, and I'm actually glad we did, because looking over here at my bookshelf, that one book that really stood out to me was Perry Kaufman's New Trading Systems and Methods. That to me, at the time, I had done some manual trading, and I had worked with developers at a couple different firms, and I knew how to think programmatically to work with developers. I had taught myself some coding, but this Perry Coffin book was the first time I really was introduced to a more systematic scientific approach to backtesting, and this is where he really talks a lot about how to interpret results, how to look at maps of backtests, and how to pick the most robust settings, different types of. I mean, he just covers a bunch of different stuff in terms of backtesting, but also more sophisticated analysis. Yeah, that book is great. Another book that we read was the Aronson Evidence-Based Technical Analysis. And it's also a good book in terms of looking at approaching the markets from a scientific perspective and trying to quantify ideas. Because that, to me, that's what it all comes down to. Like, how well did it work? You know, you're going to hear a lot of things as a technical analyst, as traders. There's a lot of lore, and the question is, how well did it work? And for the most part, you can test individual ideas. That's the one thing I don't think we really went over it, but there are certain aspects. There are very successful manual traders, and there's a component of manual trading that is very difficult to quantify. So that won't ever. Well, I shouldn't say that, but I don't think that people have had much success in implementing a more holistic approach that combines a bunch of different, I guess, inputs into the forecasting model. But those two books, anything that you can really do to start to think more in terms of how to interpret data scientifically, significance. Aronson talked about level of significance, p-value, stuff like that, the probability that, and also he also talks about, which is related, is the Null Hypothesis, which is an important part of any systematic approach, which is you're going to, it's the burden of proof is on, in any sort of scientific test, the burden of proof is on the experimenter. And so the Null Hypothesis just assumes that whatever their theory or whatever their thought is, like the Null Hypothesis for RSI would be that RSI has no predictive value. And so there's ways to quantify what the p-value will tell you, which is the probability value, is what percentage chance based on a normal distribution would this result be. And so, they have a level of significance, and, this way you can kind of systematically come up with the best areas to put your money in based on the probability that there really is some sort of predictive value in the approach.
Okay, so the emphasis is more on speculation and predictions, right?
Yeah, those two. Yeah, definitely. Because that's been my path, my career path. So those are the books that really got me excited and really took my approach to the next level. Yeah.
Okay, you didn't mention the authors, but you can give me that later, the authors and the title, for me to get them right. And the last thing we would talk about, based on your own experience, and given that you've done this for long, what would you tell beginning traders or people who've just been trading for a couple of years on how to go about trading? Because from what I know is that I cannot teach someone how to trade, that it cannot be taught, but it can only be learned through active participation in the markets. What would you tell them?
Okay. Well, can I just quickly say, I'm looking at this. I think if you have a lot of traders that are doing manual and technical analysis, I think an excellent book is The Master Swing Trader by Alan Farley.
Yeah.
I read this book, 10, 12 years ago. And it's just an excellent, he's a great author. He talks about, it's hard to really summarize this book, but he really if you want to look at a swing trading type time frame approach, I would highly recommend it. And he brings in a lot of the psychology and the pitfalls of trading too. So I just want to quickly say that. But in terms of talking to new traders just starting out, I would say I tend to disagree a little bit. I think that trading can be taught. I think that I completely agree that you need to be doing it. You can do someone asked me at my job, he wanted for his son just to get interested in investing. And there are a lot of virtual market things you can do online for free now as an aside. But for me, what worked when I first started trading, it was a wonderful opportunity for me, and I wasn't going to let it, I was going to give myself the best opportunity to be successful with it. And what I did was, and I had the fortune of sitting next to a really well-known, really good trader he was one of the most successful traders at the firm, but he'd been written about in books and stuff. And what I did was I just said, look, this guy's making money. How does he do it? And I just modeled what I was doing after what he was doing, and he took me aside a couple of days and just showed me what he was doing. And, when the market slowed down and he said he traded a position for me right in front of me. And I broke it down and systematically, and I said, this is what he does. We were reading the tape, you combine that with some technical analysis and trying to pick when the market would turn or when the market was selling off and then bouncing. We had some indicators that really were helpful. So what I would say really is you need to find someone, and that's the great thing now is, you also have to be careful. People could be, exaggerating themselves online, but you need to just find someone who's successful in whatever market you're trading right now, because that can change a lot. You have to also look out. People online will say, it might not be really relevant to what you're doing. And even like if it's a year old, it might not be, but find what they're doing and just replicate it. Because I'll tell you, and another thing I would say is that you have to approach trading as if it's a game. People used to say that back then. And if you think about the money, you'll not be, I want to say you won't be successful, but it'll definitely, I think it definitely hurts your chances of being successful. You have to look at it as a game, and how are you going to succeed at this game? I sat on this desk and we would have these guys come in who were trading their own money, and anyone who came in and they saw the guys making big money, even this trader that I was trading with traded these stocks, and I never traded the stocks that this guy did. I took his approach and I traded something that I was comfortable with in terms of its volume and volatility profile. And I found success in that. And I never wanted to trade these stocks with big wide spreads that moved hundreds of dollars a day. But you have to think of it as a game, and you have to figure out how people that are successful do it and just replicate that. These guys that came in, that all they wanted to do was, they saw the big dollar signs, they blew their accounts up with, across the board. And I saw them, it wasn't a long line of people like that, but small sample size, but 4 or 5 guys, 4 or 4 or 5 for 5. That's what happened. So yeah. Just focus on the game, and the excitement of it. And you accept that you're not perfect, but it's about minimizing losses and surviving in the game, because as long as prices move, and you're in a position, if you're a short-term trader, that's what it's all about. It's about knowing where the market's going to go for a little short burst and just being in it, and then, kicking your shares out right before it stops.
Okay, I think that's good advice, pretty much. Thank you for your time, Taka. You've spoken to us about a lot of things, and this will come in handy to us and to everyone else who listens to this.
Glad to help.
I'm glad that you made the time on a Sunday.
Hey, that's fine. This is I'm so busy during the week, so it's just the best time for me, but glad to help. It's fun. I like to talk about this stuff, so.
Yeah, we'll be delighted to have you probably in the future. For now, thank you, and have a lovely weekend.
Okay, thanks, Sylvia. You too. Talk to you soon.
Bye.
Bye.